Hello. Our class today will be an example that demonstrates the 5-step model of IFRS 15. As you can see in the board, we've got an example to illustrate just that. So, a telecoms operator, ABC Corp, entered into a contract with Johnny on 1st July 2X1. In line with the contract, Johnny subscribes for ABC monthly plan for 12 months. And Johnny receives a free handset from ABC. Johnny will pay a monthly fee of a currency of 100. Johnny gets the handset immediately after receiving contract signature. ABC sells the same handset for a currency of 300 and the same monthly plan for a currency of 80 rands a month without a handset. Now the question that we want to ask is, how should ABC recognize revenue from a contract with Johnny in the year 2X1 under IFRS 15? So we use the first step, which is you first have to identify a contract. So in a 5-step model, you've got 5 steps. The first step, you identify a contract. So in this transaction, what is our contract? There is a written contract between Johnny and ABC Corp. So that is the first step. You identify a contract. Within the contract, what are the performance obligations? So the telecoms operator has a set of performance obligations. The first obligation is a network service plan, the monthly plan. The second one is a handset, so they have to deliver a handset. The second step that we need to do is to determine the transaction price. So what is the transaction price of the contract? As you can see, our contract is Johnny will pay a monthly fee of 100 rands, and the subscription is over 12 months. So the total transaction price will be taking the 100 rands, multiply it by the number of months of the contract. So the complete transaction price of this contract is 1,200. Then the fourth step is we have to allocate the transaction price to the performance obligations in the contract. So we identified how many performance obligations. So we identified 2 performance obligations, which was the network service and the handset. But then how do we allocate this transaction price? So one way we could do that is to look at these performance obligations and identify their standalone price, meaning what price if Johnny wanted to buy these performance obligations separately, for instance, if they wanted to purchase the network service plan separately, or if they wanted to purchase the handset separately, how much would they pay? So we understand from our question that you can purchase the handsets for $300, and also the monthly service plan without a handset is $80. So over 8 months, what is 80 multiplied by 12? That is 960. And what is the handset? That is 300. So we found that 900 plus 300 gives you the total cost of the standalone prices, meaning the prices you would pay for these performance obligations if we were to purchase them as Johnny separately. So how then do you allocate this 1,200? You have to allocate it using the proportions of the standalone prices. So what do? You first have to add both standalone prices. That is 300 rands plus 960. What do you get? You get 1,360. So how do you allocate this 1,200 rands? You allocate the 1,200 rands to network service by doing what? By saying 960, divide that by 1,360, then multiply it by 1,200. Then you are able to get 914.209. The difference of that will give you also the proportion for the handset. But remember, you want to understand how much revenue will you recognize. So the network service, unlike the handset you get at a point in time, meaning that as Johnny, you are able, the minute you get into the contract, you receive the complete handset, but the network service, you get that over time. So the company then, the network provider, will have to recognize that revenue relating to network over time. So which means you take that 914.29, you divide it over 12 months. So each and every month, the revenue that you recognize is 76 rands 0.2 relating to the network services. But the revenue relating to the handset, because you deliver it the moment you enter into the contract, you immediately recognize it. So the performance obligation one, which is network service, it is at a point in time. It is over time as monthly network services are provided. So it is when you're providing these monthly network services that you recognize revenue relating to that. But the handset, it is at a point in time when the handsets are delivered.